Time for another week ahead video, guys. Our video will cover the trading week running from 26 to 30 April this week, and it's not going to be an all exciting one in terms of upcoming events this week. Our main focus will turn to the FOMC policy meeting, as well as US Q1 GDP, and then of course a continuation of earnings season with big names reporting this week. Now, the past week saw an interesting week unfold for global asset classes, with some moving as expected and some moving a little bit against the grain still. The biggest surprise in the week was the announcement that the Biden administration was looking to almost double capital gains taxes, which did of course send some short-term jitters across the equity space. Now, even though the initial knee-jerk reaction in equities to the downside was to be expected, the fear was a little bit unwarranted for a couple of reasons in our opinion. Firstly, markets were expecting capital gains taxes to increase anyway. Maybe not at double the rate, but they were expecting those taxes to increase. Secondly, the impact that capital gains taxes, the hikes usually has on equities, is another reason not to have overreacted. If we take a look at this research from Goldman Sachs, we can see that the usual impact that a hike in capital gains taxes has on equities is usually a very short-lived thing. Also keep in mind that if they announce it right now, it will take weeks and months for that to actually get passed. So that means that by the time that it actually does get passed, there's going to be enough time for equities to really get over the idea of higher capital gains. Thirdly, we need to remember that proposing a doubling of the rate is one thing, but getting that approved in the Senate, where you already have a very razor-thin majority on the Democrat side, that is quite another. So, there's a very real chance that capital gains taxes are hiked, but the proposal that we're seeing right now is, in our opinion, just the starting point. And given the way that stimulus bills was negotiated really tooth and nail, this will be no different in our view, and the likelihood of the full proposal being accepted and brought into law is looking very unlikely. So even though equities did take a shot across the bow in the short term, once markets started to digest the news on Friday, we saw equity markets calming down and continue its steady grind higher in line with that medium-term bias. We also had reports out on Friday already seeing some pushback on the idea of a high 40s rate, with sources saying that the final bill is more likely going to bring capital gains taxes closer to the high 30s. Now, apart from that, the incoming data we saw this week once again came in surprising to the upside. The market flash PMIs coming in above expectations. We also had initial jobless claims printing the lowest post-pandemic print. So all in all, positive data. Now, despite the continued improvement in economic data, it seems that US 10-year bond yields just hasn't gotten the memo yet in terms of that continued improvement in the economy. The move in yields has been a little bit of a head scratcher, as nothing has really changed in terms of the growth and inflation outlook. Arguably, with recent data in mind, the outlook has gone from strength to strength. So yields have not really joined the equity party right now. The move lower in yields arguably has also been one of the key drivers for the dollar, pushing to the downside. But it is worth mentioning that after a lot of that oversubscribed short positioning in the dollar has been unwound recently, the dollar simply moved back in line with its medium-term bias, in line of the market's expectations of that reflationary environment and that global synchronized recovery. Now, the very calm comments from the Fed recently, I think, has also played part in the move in yields. Their commitment to keep policy easy despite everything going on, I think, has been weighing on bond yields. However, a lot of the downside could also be attributed to lots of increased foreign demand out of places like Japan for US bonds due to that attractiveness of an FX hedge yield. It seems a little bit odd that yields have been able to stay lower and pressured. There has been reasons like we mentioned, but still, if we just take a look at the overall growth and inflation picture, as long as the news continues to pile in, as long as growth and inflation continues to improve the outlook, it should become more and more difficult for yields to stay low in this current environment. However, there is a few reasons for us just to be cautious as we head into quarter three, not only for yields, but for equities as well. Just like quarter two this year has some of the easiest base effects due to the pandemic that hit economies hard in quarter two of 2020, when we move into quarter three of 2021, that's going to be a very stark contrast to that, because that'll face some tough comparisons as economies started to really meaningfully rebound back in quarter three of 2020. Apart from that, we are also approaching, of course, some tough seasonality patterns for equities. If you consider just the historical comparisons of equity performance, usually in the summer months versus the winter months, it's very easy to understand the popular phrase of sell in May and go away. So, even though nothing has really changed for the outlook of these key major asset classes, we are moving into a period where we do want to just trade a little bit carefully and make sure that we don't become too complacent with our medium-term outlooks. So turning our attention then to the week ahead, there's only a handful of events that participants will be watching this week. We have the FOMC policy meeting, Q1 GDP for the US, and then of course earnings releases for those big FANG names like Apple, Amazon, Facebook, Tesla, Google, all of them reporting this week. So let's start off the FOMC. Many participants is seeing this meeting as really much a non-event and just another chance for the Fed to basically stick to the same language and emphasize their wait-and-see approach. At the previous meeting, we saw the Fed explaining that they're not looking for forecasts, but they want to see actual data change before they even think about normalizing. Now, that means that they want to see a meaningful recovery in the labor market, and they want to see inflation sustainably above 2%. The thing is that at the current pace that economic data has been improving, there is a growing risk right now that the June meeting might be the first opportunity for the Fed to really start alluding to the possibility of some tapering of QE at the latter part of the year, because consensus right now are expecting growth to run much higher than the Fed is currently anticipating. Consensus is expecting inflation to reach close to 4% due to base effects, but there are some banks, now most of them think it's transitory, but there are some participants, some banks like ING and Nordea, that thinks that there's a real chance that inflation can linger a little bit longer than the Fed might feel comfortable with. Furthermore, employment, it surprised meaningfully to the upside last month, and with the economy starting to open up again, with the vaccination program starting to really ramp up, there is a chance that employment could really recover substantially in the next few months. So it seems that the Fed really has its work cut out for it, especially for that June meeting, if the data continues to surprise. Now, there is something else to consider when we talk about normalization, and that is that the market is usually too aggressive when pricing in rate hikes by the Fed. So that means that we shouldn't get carried away with expecting a lift-off in normalization in June just because things are looking much better right now or brighter right now. But, it also means that we can't really ignore the positive signals we're getting right. Some participants are already gearing up for a potential subtle language change at this week's meeting for the Fed. Now, in a recent note by UBS, they noted that during the January meeting, the Fed statement said that it is likely to take some time for substantial further progress to be achieved. And the bank noted, UBS that is, they noted that for the past few months, no FOMC member has actually included the words sometime in their communication. So for UBS, any omission of the word sometime from the policy statement this week could actually be seen as a signal for the markets that tapering discussions are already underway in the Fed, and that could prove to be a bullish signal for participants, whereas an unchanged statement once again should be seen as a signal that the Fed is really, really happy to signal that they are behind the curve and loving it right now. The other interesting consideration for this meeting is a potential hike of the interest on excess reserves during this week's meeting. Both ING as well as Nordea Investment Bank have explained that the ample amount of liquidity and incoming liquidity in May has placed downward pressure on the short end, with some parts of the repo market actually pricing negative. And this means that there is a real chance that the Fed has to basically hike the IOER, the interest on excess reserves, by a very small amount, let's say 5 or 10 basis points at their meeting this week. And even though this has been flagged by many participants really from a couple of months ago already, and even though it shouldn't come as much of a surprise because it's mainly going to be seen as a technical adjustment, Nordea actually explains that given the recent bout of positive surprises, and given the market's expectation for a faster normalization in the Fed, the markets might take this move a little bit too hawkish and might take it as a hawkish surprise from the Fed and could actually spark some normalization price action. If that does happen and the markets take it as a very hawkish tilt by the bank, even though it will be merely, like we said, a technical move on the bank's part, it could actually spark some downside in equities and upside in US 10-year as well as the dollar, at least until the market realizes that, hey, hang on, this isn't really such a big deal. So that is also one to watch. Apart from a potential subtle language change and apart from a potential possible small technical hike in the interest on excess reserves, the meeting for the FOMC this week should really be a quiet one on Wednesday. Now, the other event to watch is Q1 GDP. Now, as we've mentioned ample times before, quarterly GDP data is usually important, but it might not always be market moving. And the reason for this is that when we get the data, it's actually already old news, because think about it this way. We're already into April and getting into May at the end of this week, and we are only now getting the Q1 GDP data. So by the time we get it, it is normally a little bit stale. However, given the amount of substantial upside surprises that we've had in economic data from the start of the year, as well as the stimulus-induced bounce that we've seen in retail spending, as well as the faster vaccination rollout, there is some participants who think that GDP could actually see a similar surprise this week. Current estimates is looking for a print close to 6.5% for GDP. Annualized, that is from a prior of 4.3% that we had in Q4. And that is roughly, as we can see here, in line with the New York Fed's nowcast, which is currently tracking Q1 GDP at 6.86%. But we can see, if we look over to the Atlanta Fed, that their nowcast is actually currently tracking closer to 8.3%. So the question one has to ask now is that right now the maximum expectation for the markets is 10%. So the question is, even if we do see a print above the market's maximum expectation of 10%, let's say we print at 11 or 12, it's going to be very positive. But with so many upside surprises in the months prior to this, there is a chance that markets might be already expecting a higher number, just looking at the Atlanta nowcast. So that means that a surprise to the upside might not be as big a surprise, but if we do see a surprise miss, however, that could arguably see a much bigger reaction in the markets. And that is something just to take note of. Now, the other events, like we said, that could spark some volatility is the upcoming earnings releases of the big names. Now, so far, earnings season has been much better than expected. Now, to be fair, analysts do normally project softer numbers in terms of earnings, but you know, it's only Q1 earnings. It's not the highly anticipated Q2 earnings yet, and we've already seen some massive upside surprises. Now, the options data suggests that the potential move after earnings in some of the big names like Apple, Amazon, Google, Facebook, Microsoft, Tesla range between something like 4 and 8%. So there is a lot of anticipated volatility coming in from these names. And of course, given their big weighting in some of the equity indexes, any chunky moves in these big names could see some meaningful reaction in equity indexes like the S&P and the Nasdaq, especially when we talk about those big tech names. And of course, you know, also keeping other names in mind like 3M, names like Boeing, names like McDonald's. Remember that something like the Dow is a share price weighted index. It's not a market cap weighted index, meaning that these names, even though they might not be, Boeing might not be as big as something like Apple, if you look at it in terms of the Dow, it's a very important metric alongside something like McDonald's, alongside Caterpillar, alongside 3M. So those names will also be important to watch in the week ahead. And as always, you know, the earnings expectations themselves or earnings releases are important, but what participants will also be focused on, arguably a little bit more than the numbers itself, is the guidance and the outlook that they get for the future from the company. So any negative guidance could easily undo a strong beat in the earnings number. So do make sure to pay attention to that in terms of the communication this week as well. Then we also have President Biden, who is expected to provide details of his American Families Plan. Now, the reports that surfaced regarding the capital gains tax this week was in connection with that plan, and it is one of the ways that the administration is, of course, planning to pay for the plan. Now, it will be important to hear any additional information coming out from this, but some have argued that the response from more moderate Democrats like that of Joe Manchin will actually be a lot more interesting and a lot more important in terms of the probabilities of the hike actually going through, and if it does, what the eventual size of that hike in capital gains taxes will be. So that is also something to watch out for. And the other thing to consider is that the end of the month, the end of April, is coming up on Friday. So we do need to keep the odds of month-end rebalancing in mind, which can make for a tricky and a messy environment to trade. So also something just to keep in mind for the week ahead. So in terms of a trade plan, guys, given the lack of any major one specific catalyst, our focus will turn to the broader range of assets with these broader ranges of possible events, and with some possible bearish and possible bullish reactions from them. So starting with the possible bearish outcomes, in terms of the FOMC meeting, if the Fed keeps all their language unchanged, so then don't make that move in terms of the sometime, as mentioned by UBS, that is expected to, just see further downside in the US dollar, further downside in US 10-year, and that could see some upside in equities like the S&P 500. If they keep the IOER, the interest on excess reserves, unchanged, with a lot of participants now expecting that hike to actually occur, if they don't follow through with that, it's just basically going to hammer through the idea that they really want to stay behind the curve. And that could also weigh on the dollar. It could weigh on bond yields, and it could support equities further. Turning our attention to Q1 GDP, if we see a print below the market's minimum expectation, that's going to be negative across the board for the dollar. We expect it to be negative across the board for the dollar, bond yields, as well as equities. If we see earnings surprises to the downside, that's going to probably see some upside for the dollar from a safe haven point of view, and expected to see downside in bond yields and S&P 500. And if we see moderate Democrats actually backing Biden's proposal for an almost doubling of that capital gains tax hike, that could actually be seen as a negative across the board as well. Negative for the dollar, negative for yields, and negative for equities as well. Turning to the bullish outcomes, it's just the opposite. If the Fed opts for a more hawkish language by basically removing that sometime phrase, as we explained that UBS noted, that could see some meaningful upside for the dollar as well as yields. That could see some downside for the S&P. Turning our attention to that IOER hike, if they do follow through with that 5 or 10 basis points, remember, as we said, if they do that, it's really going to be a technical hike. It's not going to be them signaling that they're turning hawkish. It's really just going to be due to the suppression that we've seen happening at the short end of the curve. So we would expect that to have that bullish reaction in something like the dollar, as well as US 10-year, and negative reaction in the S&P. But again, the moment the markets realize that, hey, this is actually not that big of a deal, we might see that fade quite quickly. So just keep that in mind. In terms of GDP, if we see the markets coming in above the market's maximum expectation, that'll be a print above 10%, expecting upside across the board. Now, we have seen yields and the dollar, of course, move lower recently on better than expected data, but in terms of the usual way we expect these assets to react, we would expect upside across the board. If earnings surprises upwards meaningfully, that could see some downside in the dollar from a safe haven point of view. Upside expected in that occurrence for US bonds as well as S&P 500 bond yields. Upside in bond yields, downside in bonds, upside in S&P 500. And then if we see moderate Democrats walking back against that capital gains tax hike, that is also expected to see more upside across the board. That is already expected to occur, so we're not expecting that to be a huge game changer in terms of the assets, which is why we expect a bigger reaction coming out from them actually backing that in terms of the bearish outcomes. Now, guys, do remember that the potential outcomes we've just explained, the potential market reactions, is merely a guide for what we would expect in the event of these various outcomes. And please do keep in mind that the markets can always surprise in the way that it reacts. So the expected impact is never intended as a trade call, but rather intended as a guideline and a framework for your own scenario planning in the week ahead. So guys, I want to thank you for watching. As always, any questions, don't hesitate to let us know.